Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger. Of course, I'm the host on the weekly series for the ISE webinars. Not only weekly, although sometimes we actually do it twice a week. This Thursday, Jack Brooks will be presenting. So I'd urge all of you to come back on Thursday. Jack's going to be talking about how currencies are valued. But today we have Stefen Choy. Stefen will be talking about defining and using implied volatility to trade FX options. So he's the co-founder of LiveVol. He's going to show you some really cool stuff about volatility, what his business. They actually have a business that retail investors can use to help them trade the markets, and Stefen will talk more about that. So let me introduce Stefen Choy. Stefen, thanks for coming.
Thanks for inviting me.
We appreciate it. Sorry you had a couple issues. It's okay. What I want to do is just run through the basic slides, and then you could talk about volatility because I know you're an expert on it. And then you could show people a little bit about LiveVol. How's that?
Sounds awesome. Sounds awesome. Thank you.
Great, great. All of you know that when you're trading options, the option disclosure document is really, really important. So you can get the characteristics and risks of standardized options through your broker, or you can call 1-888-OPTIONS or go to optionseducation.org. Anything that we talk about today, of course, is not an endorsement for any sort of trade recommendation. We're not doing that. We're just using examples, and taxes, margin, and commission are not included. They're very, very important. So, Stefen, why don't you take it away and tell us why or define implied volatility, historic volatility, and enlighten us on what volatility really means.
All right, cool. First of all, I want to thank Steve for inviting me. I'm happy to be here. I think it's great that you can actually come to a place like this and learn about options. I wish when I started trading, I could go someplace like this and learn about trading. And I want to thank everybody for joining me. Basically, I would like to start off by saying, why is volatility important? Well, basically, when you're pricing an option, there is 5 components to it. And 4 of those 5 components are basically known. So the only part that's not known is volatility. Now, if you actually knew what the volatility was every time, you can basically, every price that's out there would be fair value. So you would never have to, there'll be no arbitrage to actually make any money. One of the things I can actually use as an example is if the stock was trading 50 and the 50 level strike with 1 month of expiration using current rate and price the straddle, if you look at stock A that is 60 vol, you can see the straddle is priced at 687. Now, hey Steve, can you see the arrow?
No.
Okay.
You got to click on that arrow, and then just go right back onto. It should work. If you click on the arrow and then go into they made you the presenter.
Okay.
That's me doing it. You should be able to do that, doing the same thing. Are you going up, Stefen, to that little arrow and clicking on it? The pointer?
Is the pointer? Whoa.
I got. It's all right.
Where's the pointer?
You see right below the tab, Stefen Choy, there's a little arrow. It says there's an arrow right below the T. there's an arrow. If you click on it, take your mouse and click over that, then you're going to have the ability to show people, wherever you want to go.
You said underneath my name?
Well, no. You see the tabs at the top, Quick Start, Info, and then the tabs, Stefen Choy?
Yeah.
Right to the left of it. Just go diagonally down to the arrow. There's a little pointer there. You see the icons? There's like an eraser, there's a color, there's right here.
All right. Do you see it now?
No. Huh. Oh, wait, I don't know. You're using something different. I don't know what that is, but I see it now.
You do?
I see a little thing. It's not the arrow, though. It's not the pointer.
How about this one? Do you see an arrow now? Or pointer?
Oh, yes.
Okay.
Okay, excellent. We're good.
All right, so if you see the straddle right up here, it's priced at $6.87, and it's 60 volatility. Now the same stock with only 10 volatility is priced at 115. So you can kind of see what a tremendous difference it is by having different vol setting your prices for options. Now here to the right is the Vega, and we'll talk about that a little later. Now the implied volatility is the current volatility level required to generate option market price. So the way this is actually priced is by the demand of the options. So if a lot of people are buying options, basically the implied volatility would go up because as market makers sell these options, they will raise the price. Also vice versa, as the stock goes down, the prices will go down. The IV30 is the weighted blend of prices for range of options on the underlying. The goal is to estimate implied volatility of the underlying over the next 30 days. So I think everyone knows about the VIX. Basically, that measures the whole market. The IV30 basically measures the VIX of each individual stock. So if you're trading IBM, the IV30 will basically tell you what the options are saying the volatility of the stock is going to be within the next 30 days. The next one is HV30. This is historical volatility, the annualized volatility of the underlying stock over the last 30 trading days. So basically what this does is this takes the last 30 days of how much the stock moved and calculates it. The Vega is the change of price of options that results from 1% change in volatility. So basically what Vega does is every time the vol point changes 1 point, how much does the price of your options change? So in this straddle example on top, you can kind of see how the Vega is 11.5 cents. You can kind of surmise that if the volatility went up 50 points, the difference is about 550.
Hey, Stefen, are you going to get to where the attendees could get the IV30? You're going to show us that in a little while, right? I just had a question.
Right.
Attendee. Thank you.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.